Hi there, welcome to Wealthy and Wise. For this week, I'm Nadine Blaney from AusBiz. This week, we'll be taking a deeper dive into how to value a company because there's more than one way to do so, from detailed models to simple comparisons. But in reality, small changes in assumptions can lead to very different answers. So in this episode, we'll delve into how investors actually value companies and why the method you choose can matter just as much as the numbers you plug in. And we'll take a deep dive into a few specific companies. We will also answer a viewer question from Jean. You too can ask the team a question via wealthy@ausbiz.com.au. Let's add some value. Well, as we said, there's more than one way to value a company, from detailed models to simple comparisons. But in reality, most investors use a bit of both. In this segment, we break down two of the most widely used approaches, being discounted cash flow, you will hear it referred to likely as DCF, and multiples. So hopefully we'll bring to life how those two approaches are actually used in the markets. Welcome back, Andrew Coleman from Teaminvest. Nice to see you. And joining us as well is Dean Fergie from Cyan Investment Management. Dean, really pleased to have you here with us for this program. But Andrew, just to set the scene, I thought I might just start with you and some basics. Most valuation, as I said, comes down to DCF or multiples. Just very briefly, walk us through sort of the difference from where you sit.
Yeah, great question. So look, firstly, multiples analysis are simply using a comparative multiple to arrive at a value in sale. In other words, same thing as how we do when we're valuing our house. So we say, look, this is a 4-bedroom house. It's in this suburb. It's this number of square meters. What have comparable sales been of similar houses in a similar suburb for the same amount of square meterage? And that then gives us a comparable valuation we can use. And it's used in a lot of markets. I mean, we use it all the time in property markets in this country. We use it in real estate all the time when it comes to REITs on market. We use it in resources companies when we're looking particularly at explorers and developers, when you're trying to work out how much is the ore in the ground worth. You know, it's pretty simple. It's worth a certain amount of dollars per ounce if it's gold, or dollars per ton if it's coal, and how many tons are there and how long is it going to take to dig up. And so it gives you a really quick, pretty accurate answer, as long as the market that you're looking at is very heavily traded in what we would call in economics fungible. In other words, that house and that piece of coal is the same as anyone else's coal and anyone else's house. Where comparative multiples analysis breaks down, of course, is where the asset is unique, or there are big differences between assets, because you can't comparatively value that apple and orange, but you can do two apples. So when we have usually in the market assets that are different, like companies, which are all very different, we tend to use an approach similar to the discounted cash flow analysis. And really what we're doing there is just trying to work out the value in ownership. So we talked about comparative multiples is value in sale. DCF is value in ownership. What would I get as cash flow if I was the sole owner of that asset? Work that out over time, bring it back to the present, because time has a value, an opportunity cost, a time value of money. And then technically the net present value of all of those cash flows is what the asset is worth as a whole. And so then if you're in private equity, that's what you'd pay for the company. And if you're in listed equities, you divide that by the number of shares to work out the share price. As a result, you can get a really good specific answer. But as you pointed out in the introduction, in both the comparables multiples analysis and discounted cash flow analysis, there's a big if hanging over both of them, which is the quality of your inputs.
Yeah. All right. So we will delve into that. But Dean, let's just take a step back with you. First of all, what type of an investor are you? And which approach do you find yourself using more?
Yeah, it's sort of a very nuanced and complex question. I mean, we like to think ourselves as value investors, but I think logically, like, everyone should be a value investor. You want to buy something for less than you think it's worth. It's sort of the old Buffett adage. But back to the question about valuation techniques, I think, the DCF is used when you've got companies that are emerging, and so we like to look at companies that are growing quickly and are going to be a lot bigger in the future than they are now. And so when you've got companies that have a technology platform or software solution or something, but it hasn't really got the kind of client base you think it might have in the future, that's where you need to look at discounted cash flows and put in a lot of assumptions to say, okay, look, it's it's not doing a lot now, but what will it be doing in 3, 4, 5 years' time? And that's where you come back to what you think is a present value that is hopefully above where the stock's trading. So, for us, we sometimes like to buy things, companies that have got like strong cash backing and a lot of assets that maybe not be very popular and look very, very cheap in the market, and others that are growing strongly but maybe don't have the earnings there at the moment, in which case, we'd use a DCF and hopefully give an analysis that helps you make a bit of money. So it's just like horses for courses with us, I'd say.
Yeah, okay, interesting. And we'll talk about stock specifics in our next segment, but I just want to flesh this out more. So Andrew, in your view, why are multiples so widely used?
Well, they're easy and they're fast, which of course gives you two big advantages if you're dealing in, most markets, right? I mean, if you're in a property market and you're at an auction and you need to know what to bid, you don't want to be sitting there trying to work out on an Excel spreadsheet all of the various intricacies. You want to know pretty quickly, is this price good or not? Do I enter or not? The same thing when you're dealing with, trading resources or trading crypto. I mean, not that I'd ever do any of those things, but those are the kind of assets that multiples are good for because it's easy, it's fast, and it's pretty accurate provided there's a large amount of data on similar sales. So great for comparing options in a very quick time.
But would you say, and we've got a little bit of a breakdown that you've provided on strengths and weaknesses in your view, DCF is widely seen, I would say, as more rigorous. Would you agree, or why is that?
Yeah, well, both from an academic standpoint, it is a more rigorous model. You're not simply just taking a snapshot of averages of other things that are similar and applying an average to it. So as a result, it's more rigorous and considered because you need to put more assumptions in. By the way, being rigorous and considered doesn't necessarily mean more accurate. It just means more work and more thought through. But it's also particularly enjoyed as the sort of gold standard in legal disputes. So, if you sort of want to assume that the courts take a view that the approach is a better approach, and I'm not quite sure why we think the courts would be particularly good at valuing things, but they seem to think they are appropriately designed. They almost always will pick a DCF over a multiples approach because of that considered rigorous asset-specific approach. And the big advantage of the DCF is exactly that. It's asset-specific, and so it allows you to explicitly consider growth, quality, and risk in a way where a comparative multiples doesn't. In a classic example, and I think it's easy to sort of think of it as a company versus a house, right? So if you've got a company that is earning, $100 a year, but you're unsure of its growth rate, what's the comparable multiple you should use? Well, do I use a low multiple or a high multiple or an average multiple? There's not a lot of flexibility in that. Whereas in the DCF approach, you can be much more rigorous, pull that apart, work out the levers, and hopefully arrive at a more detailed and therefore more accurate result.
Yeah, Dean, in your view, how reliable is DCF in practice? Like, does it come down to how much confidence you have in the inputs?
Yeah, look, I like to laugh that a DCF is very good to back up what sort of price you want to pay for a stock or what sort of valuation you like to get. The problem with DCFs are they're incredibly sensitive to the inputs you put in, and specifically, people talk about a 2 or a 3-stage DCF model, and you've got sort of your current cash flows coming in at the moment, what you think they'll grow to over the next sort of 3 to 5 years, and then the terminal growth rate. And normally the terminal growth rate sort of maybe weighted average cost of capital, so that might be sort of 4 or 5%, but you might think, oh, well, maybe it's 6%, maybe it's 7%, maybe the growth rate over the next 4 or 5 years is not going to be 12%, it'll be 15%. And you put in a combination of those figures differently, and the valuation could move around by sort of 30, 40, 50%. So it kind of could be good to validate what you're inherently thinking, but unless you've got extreme confidence over those numbers you're putting in, the value you come back with now swings around a lot. So I'd probably use DCF models fairly hesitantly because of those shortcomings.
Yeah, so Dean, that's why investors often fall back on simpler things like multiples or even customer-based metrics. Is that right?
Yeah, look, that's my view. We're in a market at the moment that seeing share prices move really aggressively. There's a lot of momentum out there, and you kind of come up with almost whatever valuation you like. And so if you've got near-term valuations in terms of how many customers do you have, what's your current revenue, what's your current profitability, what's your market capitalization, what's your enterprise value, they're strong, defined numbers that if you can compare reasonably like-to-like businesses, then I think you come up with a really good comparison and a really good mindset as to what you should or shouldn't be paying. Because I think DCF's a little bit like, it's more of like an I think model. I reckon it's worth this in the future, and no one else cares really what you think.
Yeah, right. Andrew, so how do you approach this? Is it, again, coming back to what we've discussed in previous episode, focusing on businesses that you feel with a great deal of certainty that you can predict the inputs?
Yeah, I mean, look, Dean, 100% right. Whichever method you choose, in the end, you've got to assume two things. Number one, the models, because they're mathematical models, are incredibly unstable. So what do I mean by unstable? I mean exactly that point that Dean was talking about, which is a very small change in your input assumption can result in very big changes in your output calculation. And in anything that you're doing in life, if a small change in the input makes a big change in the output, that's a recipe for disaster unless you can, to your point, have very high degree of certainty that those inputs are going to be right. And if they're not going to be right, they're only going to miss by a tiny amount. Now, in the world of asset price valuation, like we're doing in the stock market, that's hard to do because the world isn't stable. Companies aren't stable, people aren't stable, and companies in the end are run by people. And so there's only a very limited number of companies that I think you can actually use any form of valuation model to arrive at a stable valuation on. That's why we talked about stability so much in one of our previous episodes. If you filter the market for stability, in other words, those companies where you could have a high degree of confidence in your model, you end up with only sort of 3 to 5% of the market left. So from that point of view, I think you can use multiples or a DCF when you're looking at that portion of the market, and you'll be pretty close to right. If you're trying to forecast something about the other 95% of the market, well, I mean, back in my days as a junior analyst, I used to ask the question of my boss, are we on the buy or sell side? In other words, do you only come up with a high valuation or a low valuation here? And that tells you the stability of the models.
Yeah, all right. So for investors, what is the key lesson here? That the model matters less than the assumptions behind it?
Yeah, I think all models are just simply a tool to help you play out a scenario and see how that'll work. So if the scenario you're playing out is one that's grounded in a high degree of reality, then that scenario is going to be a very valuable scenario to run. If it's not grounded in reality, well, then it's a lovely piece of fiction, but it's worth about as much.
Right. And so, Dean, I mean, I do want to leave enough time for us to go stock specific. And from what I know of you both, I think you're quite different in the companies that you choose to invest in. So when you are approaching companies, and when you would expect some viewers, everyday investors out there to approach companies, how important do you reckon stability is?
I guess it depends on what sort of company you're looking at. So, I think we might be talking about Woolworths later. You'd argue that, sort of a consumer staples business is very stable and very predictable, in which case that's important. But, you're unlikely to get a doubling or tripling in profitability over a short period of time. So I think it really depends on your risk and return, and obviously people can construct portfolios with different weightings in each of those stocks. So I don't necessarily think stability is always important. It's a lot more comfortable, but you can build a portfolio of both stable and risky assets and still end up with a good investment outcome.
Wherever you are in Australia or New Zealand, there are investors like you who are done going it alone. The best investors we know aren't just disciplined, they're connected. Teaminvest is an exclusive membership for long-term, self-directed investors who approach investing like business owners and compound their knowledge alongside 700 plus peers. With monthly masterclasses running across 9 cities. Find out if Teaminvest is right for you.
All right, let's take it from theory to practicality in head-to-head. We'll go there now. Okay, well, we know you love it. Let's go stock specific. And it's a really good way, obviously, to, put some meat on the bones of this valuation conversation because frameworks are useful, but I guess the real challenge is applying them to actual companies. In this segment, we'll put it to the test looking at businesses that are relatively straightforward to value and others where the range of outcome is far less clear. So we still do have Andrew Coleman here from Teaminvest and also Dean Fergie from Cyan Investment Management. And Dean, I'll begin with you and a company that you have brought to the table to discuss, and that is Raise. Is this a business in your view that has some pretty clear metrics? Or I suppose a simpler question is, how do you approach valuing Raise?
Yeah, so I sort of put this in the easy bucket in terms of trying to analyze a valuation for a business. So Raise is a investing platform. It's largely app based, and it has a bunch of customers that have portfolios of small investments, and they charge a monthly fee for managing that money. Has a bunch of other sort of, I suppose, bells and whistles to it, but that's the core. It's a small investors investing platform. Importantly, with Raise, you've got a company that's net cash, so there's no balance sheet risk. They have, I think at last count, 347,000 customers that pay on average about $5.50 a month. So from that, you're getting a pretty stable $25 million in revenue, a reasonably fixed cost base, and a small positive underlying EBITDA. So for me, there are a bunch of different ways you can analyze this, all of which look pretty attractive. You can look at it on a per customer basis. So you could say each customer is worth on the market cap about $150, which looks really reasonable compared to other multiples out there. You can look at it on a enterprise value to EBITDA multiple, which is around 10 times, which is probably quite reasonable given the company's early stage profitability, and that's likely to go down over time. Or you can look at it something like a percentage of funds under management. So the business has around $2 billion in FUM. So sort of looking at about 2% of funds is the market valuation, which is comparable to a number of the other fund managers out there. So there are a number of metrics that all are not terribly subjective at all, that all look pretty reasonable. And so I think that is a business that the numbers are transparent, the multiples are there, there's no subjectivity, most of them stack up. So it's a business that from a purely valuation perspective, I really like and I think is really easy to value.
Yeah, interesting. So you mentioned, though, enterprise value, you mentioned EBITDA, value per customer. Just trying to get my head around it. Is there one in this example that would mean more, or the sum of the parts is what you're putting together?
Yeah, look, I mean, probably for me, I see a lot of consolidation happening in the financial services space. And I think largely large institutions want to have active customers. So people that are actively saving, investing, or taking out loans. And if you look at a company like that and you're paying like $150, or if they want to make you fun of a takeover bit of a premium, $175, $180 per customer, I think that's actually a really reasonable price for a business to pay. So that's where I see the valuation. But importantly, all the other metrics stack up as well. It's just not like the customers are valuable, but the company's losing a lot of money, or it's got no FUM, or any of those things. Everything kind of builds on top of that valuation. So everything kind of makes sense, which gives me a lot of comfort in terms of investing in the business. But for me, this is an example where, that sort of dollar per customer metric is probably the most important one from my perspective.
Andrew, this is head to head, so honest answers only. But when you look at a business like this, does it look valuable in a traditional sense to you?
So I'll preface with saying I really like Raise as a business, and I know Brendan quite well, who's the CEO there, and he's done a wonderful job, co-founder and CEO, taking it to where it's got to. But from a Teaminvest point of view, it's in a too hard basket. And it's in that too hard basket because even though the underlying business is quite a simple business to understand, clip the ticket on all of these customer accounts, and I think what they're doing is wonderful. Because it has been in startup and growth mode, it doesn't yet have a track record that says we can really point to its ability to deliver that sales, which are growing at about 10% per annum, into profit on a regular, repeatable basis. And so from a Teaminvest point of view, we talked about before that there's only a few percent of the market that's stable enough that we feel we can be very virtually certain about the number we come up with in our valuation. And as it's your own hard-earned money that you're investing in that, you want to be virtually certain you're not going to lose your money. Raise just gets put in that bucket, which is, clearly there's a good business here of some description. At some point in the future, it's probably going to be worth an amount of money. The problem is to work out, is that amount of money 50 million, 100 million, 150 million, 200 million? And with a range that wide, how do you know if buying it on a market cap of, say, 65 million, which is roughly what it's trading at today, will deliver you an adequate return for your risk? And, Buffett's rule 1 is don't lose money. Buffett's rule 2 is never forget rule 1. That's the challenge when you're looking at newer businesses or businesses with less stability. How can you be virtually certain that this one, over the long term, will deliver you the kind of return you want?
All right, well, let's talk about Woolworths then, because I think you've brought a Woolworths analysis along for us to take a look at. How does Woolworths stack up in terms of transparency, visibility, stability, but also, predictability in determining its value?
Yeah, so I picked Woolworths, CSL, and 360 as my 3 because they're the 3 companies we did on episode 1 when we were talking about valuation. But I didn't pick them because I liked them then. I picked them because I wanted to show how the range in valuation outputs you can get differs materially with really small changes in your valuation model. So talking about that sort of instability that Dean and I were speaking about earlier. So what I've done here is just run a really quick DCF on Woolworths, which is the sort of text in the top left, showing that at its current earnings, if it grows at 4% per annum for the next 10 years, using a relatively standard discount rate of 10%, Woolworths looks like it should be worth about $37 a share. So that would give you about a 10% return if you buy it. So not exciting, but maybe something that an investor would like. But then I had a look and said, well, what if you just change those by 1% or 2%? Very minor change, 1 or 2% is very much in the realms of normal business operations. And suddenly it turns out that you can have a range of Woolworths of anywhere from $31 a share to $68 a share on those charts. And in both cases, by only changing the assumption of growth rate by a tiny amount or the assumption of your risk by a tiny amount, we're talking 1 or 2% changes here. So I would look at a company like Woolworths and say, whilst the underlying business is a stable business, because its track record of delivering profits is not very stable, it goes all over the shop amusingly, even though the business itself sales are pretty steady. How do you predict, or how do you know as an investor if this is a $31 a share investment, in which case paying $34 would be a silly idea, or a $68 a share investment, in which case happy days, run to your broker and buy as much as you can? And it's just an example, again, of how these models are so unstable if you're not certain about your inputs.
Okay. Now we can jump to CSL if that helps keep this narrative going. I didn't give Dean right of reply on Raise, but we'll get back to you in a second, Dean. So what are we seeing here then with CSL? Because this is a company that I know you guys believe is very valuable.
Yeah, well, CSL's one of those companies that has a very high degree of stability in terms of its sales and its earnings. Not its share price, but its sales and its earnings. Its sales have grown at an average rate of 12% per annum, with 95% stability over the last 10 years, and earnings have grown at 10% per annum with 91% stability. That's in the top sort of handful of companies on the ASX. Take out all the noise at the moment, just the pure numbers. So from that point of view, if you build a DCF model on CSL, if you want to own it, you've got a very narrow range of potential inputs because you've got a very high degree of stability. So I've just run again, example, same as Woolworths, took this time 6% growth, which is well below the average of the last 10 years. That's been at 10%, as we just said. And at a 6% growth with a 10%, discount rate, which again is a pretty standard market assumption, you've got CSL looking like a screaming buy, worth $356 a share against a current market cap of 125. And then do the same thing as you do with Woolworths. Run a scenario where you halve the growth down to 3%, still worth $278 a share, and increase the risk, and it's still worth more than the current market cap. So in that case, it's not one that I can say with any degree of certainty what number the share price will be, but it's one where under any sort of margin of safety, it looks like it's worth a lot more than it's currently trading at.
So margin of safety is important to you. And I think it's worthwhile that this is longer term outlook, because the share price is I was talking to somebody the other week and they were calling CSL a basket case, and they weren't just talking about the share price, because things can't change in the way that a company is run. It's just that you choose to go on history and what the market has or what the earnings have already told you.
Yeah, I mean, Benjamin Graham said it really well. He said, in the short term, the market is a voting mechanism, and the long term, it's a weighing mechanism. And at the moment, the market is voting on CSL. Pretty clearly, there are clearly more sellers than buyers of the stock, and that's why the share price has moved down. But in the long run, at the end, 5-10 years from now, what's going to matter simply is the earnings. All that noise around change of CEO, all that noise around do they divest Seqirus or not, that's going to fall away in 6, 12, 18 months' time, because we'll know either Gordon Naylor and his team will have the company performing as it used to, or they won't. So that noise will disappear, and at that point, the market will be a weighing mechanism again. And then if they continue to perform as they have in the past, CSL is going to be a very good investment. If they don't, well, it won't be.
Yeah. Dean, any thoughts on the aforementioned, be that Andrew's take on Rays or Woolies or CSL?
Firstly, I'd probably say on Woolies, one thing we haven't really talked about is investors' appetite for income and dividend yields. And I think in a lot of cases, especially with those large, kind of massive blue chip companies, obviously CSL is one of them, the BHPs, all the banks, Woolies, Wesfarmers, that a yield is pretty attractive. Often with these businesses, the yields are very stable, even if the earnings aren't. And a lot of retail investors tend to look through that and just say, hey, what sort of income am I getting? And if you're looking at kind of 4%, that's more or less in line with cash, often with franking credits included. So you're not getting a bad return, and investors can kind of look through that. So I think, we'll look at CSL, there are a lot of expectations built into that. Like Andrew was right, it grew really, really strongly for many, many years, but I think too much of that sort of growth forever was getting factored into the share price, and that's why it's come back so strongly. That's now yielding sort of a little under 4%. Woolies is about the same. So I think they're sort of factors that, to a certain extent, will put a base under share prices so long as interest rates remain reasonably stable. So that's sort of one of the points I'd make initially.
Yeah. All right. So you brought Rays to the table. Let's contrast the transparency. You reckon it's pretty easy to value it on a number of different metrics. Contrast that with another company that we've spoken with about in the past, which is Alcidean. So it's medical software. It's got a growth story, perhaps even a similar growth story to Rays. But why, in your view, is it much harder to pin down the valuation on this one?
Yeah, I mean, both companies I really like, but they're just like completely different in terms of valuation. So Alcidean is a company that's been around for a long time, and they provide software to the hospital system. So patient tracking, clinical decision making, hospital sort of bed management, paging systems, all those kind of things. So large contracts, very long-term contracts, often sort of government-backed through the hospital system. Very sort of long-term attractive business, but with a lot of barriers to entry. What's really curious about the healthcare system or companies operating the software space in the healthcare system are the range of valuations. So the kind of the glory stock at the moment is Pro Medicus, that has software for medical imaging. That is a $25 billion company that does a couple $100 billion in revenue. So sort of 100 times sales. There's other companies out there at the moment that are not making any money at all. So 4D Medical, Echo IQ, Artria, also in that kind of medical software space, that are also capped at somewhere between $500 and $3 billion. So this is a business, well, look at Alcidean, they do about sort of $50 million in sales this year, and it's capped at about 130. So on a relative basis, I know all these businesses aren't exactly the same, looks really, really attractive, but is Alcidean too low? Are the other businesses too high? I don't know, but all I can see is a lot of comparisons of businesses that are valued higher than it. So relatively, I think it looks pretty attractive.
Mm-hmm. And so you're sort of using multiples there, just to get back to the original kind of conversation.
I think so, yeah. Look, so Alcidean, it's fortunate that it is one of these few medical software businesses that is going to be profitable this year. It is not profitable such that it looks a very, very attractive multiple. It'll be on a sort of an EBITDA to enterprise value of around 22 times, which does sound pretty rich. But if you compare it to Pro Medicus, that's on sort of 100 times enterprise value to EBITDA, it looks incredibly cheap. So they're the sort of things you have to kind of grapple with a little bit, saying, wow, there's some companies out there like the market loves. This one isn't quite getting all the love, but more so than some other ones out there. It's a little bit tricky, but we think because it's got a strong balance sheet, it's not going to raise money, it's growing its revenue base, it's growing its profitability. This is one that is maybe not seeing as much love as it could be, given the enthusiasm for some other stocks in a similar sector.
So interesting, because I would think, Andrew, that you would not be into, taking a look around and saying, well, okay, this one looks relatively cheap.
Yeah, I mean, it depends what you're doing and why you're doing the valuations. So, if you're a professional analyst, I know Dean and his team are, you kind of have to value everything because that's what your customers want you to do. It's your reason for existence. And so I think if you're confronted with a question like that, Dean and his team are approaching it exactly the way I would, which is to say, well, I don't really know where it's going to be. Let me have a look at value in sale, what others are transacting for, and get a reasonable answer using that. So I think they're doing it exactly the right way. I think the big advantage we have at Teaminvest and our members have at Teaminvest, and probably many of the viewers have at home, is we're not engaged to do valuations for other people. That's not our job. And we don't have to have an opinion on all stocks in the market. In fact, you really only have to have an opinion on the assets that you own or you would like to own. Everything else is kind of noise, right? And so as a result, you have the choice of being able to say, well, all of these difficult to value ones, I'm just going to put in a too hard basket and leave them for another expert. And instead, I'm going to put my money only into those assets where I'm virtually certain that my valuation can be right. And, to us, that means going through a three-step approach. It means, firstly, focus on stability. Don't worry about valuing it if you think you can't. Secondly, put a big margin of safety in, run those scenarios like we just showed to work out that, is there a plausible scenario in which I might lose money? And then number three, having looked at the moats and the risks of the business and the trustworthiness of management, and maybe talk to your fellow members to get their opinion as well, only invest when you can be virtually certain that your model's right and that the downside is protected. Okay. And that way you do pretty well.
So listen, Life360 is a stock in the tech space that has divided the market. It's been showing good growth. Share prices come down as well. So how do you value a company like 360?
I think it's very, very hard. I mean, I used it as an example because we used it in the first episode, but it's a really interesting example because since listing, Life360 has grown its sales at 35% per annum, which is pretty spectacular. Of course, it's made a profit for the very first time this year. So the question becomes, when you're running any form of valuation, whether that's a multiples analysis or a DCF, what's the growth rate? Who are the comparable peers? And what's the risk associated with it? And so similar to Woolworths, you get quite a large discrepancy in valuation depending on what of three pretty reasonable scenarios you play. I mean, there's one reasonable scenario to say that Life360 grows its earnings at sort of 15% per annum from here, because with sales growing at 30%, that's very achievable. In which case, I can understand some of the hype about it. On the other hand, there's a scenario that says, because it hasn't been able to translate that to profits are really only going to grow at, say, 5%, in which case it doesn't look like a great buy. And I think we were on the call a few times, you and I, when Life360's come up, and I've been pretty scathing about it as an investment case in the past, on the basis that how could you possibly value it at the billions of dollars of market cap that the market was assigning when you have no idea of the profitability of this business into the future? The market seems to have cooled a little bit on it. I still wouldn't touch it because it's in that too hard basket, but maybe if it's something you have as a deep circle of competence, it's something to be interested in now. I've made the joke before, though. I do like their business model, which is that they're able to keep a tab on all of the most valuable things of all their shareholders, being their kids, their pets, and their wallets.
Yeah, all right. Dean, any view on 360 and valuing a company like that? A hot tech company, the momentum gets behind it, but, arguably was overvalued.
Yeah, I mean, if you look at the share price, it is just a classic head and shoulders at the moment. It had this massive spike and it's on the way down. So if I was a technical investor, and there's a lot of merit to being a technical investor at the moment, I wouldn't be going near it. There are a lot of things to like about it, though. They've got a quality product. It's got very, very strong revenues. It's a subscription model. It's a growing customer base. So all those things, are valuable and attractive from an investment perspective. It is, again, what you pay for it from a multiple perspective. I think it's on sort of about 80 times earnings. So it is factoring in a lot of continued growth in the customer base or upside in their pricing, which they can probably push through given they've got such a loyal customer base at the moment. But at the moment, it looks like the momentum's against the company at the moment. Is disappointed a little bit in terms of its earnings. So when the market kind of sours on these things, you don't want to try and sit in the face of us and saying, oh, I think it's a good buy at these levels, because at the moment, like, the share price looks like it's trading down, and it's still pretty richly valued on current earnings.
Yep. All right. So listen, we could keep going with the companies, but what would sort of be, from your world, funds management world, Dean, one sort of rule of thumb when it comes to approaching value in companies that you think would be valuable for investors?
I mean, for me, it's keeping a really close eye on the current numbers. Like, every company wants to talk things up and talk about how great things are going to be next year or the year after, and what sort of margins they'll get, and how big the total addressable market is, and all the blue sky. My view is, look out the window at the moment. Is it sunny or is it cloudy? And are those figures coming through in the numbers at the moment? And if they're not, then I think it's best to be a little bit wary of those companies. This is, I suppose, more in the kind of emerging microcap space I'm talking, rather than big established companies. But if companies aren't proving themselves currently, I always become a little bit wary or cynical.
Yep. And Andrew, so the real skill, as you see it, is not valuing everything. It's, I suppose, knowing what can be valued, knowing what should be valued.
Yeah, I think you can get into a very difficult spiral if, as a private investor, you are trying to spend 24 hours a day valuing companies to find something that looks like a good investment, and then you have to watch it like a hawk to make sure that something doesn't go wrong. I mean, if that's your career, that's fine. But if you're doing it as a private investor at home, that sounds like a recipe for being late to the party and ending up a little bit like Cinderella after midnight. And I don't like my investments to be pumpkins. So I'd rather stick to things that I know I can value, and value them accurately, and then hold them for the long term.
Got it. All right. So, right. So Dean has generously said that he will stick around to help answer our viewer question of the week, because you asked. All right, you can ask the team a question. Just email wealthy@ausviz.com.au. And this week's question, it's a simple one. Well, all questions are loaded, aren't they? And it comes from Jean, who's asked the team to take a look at JB Hi-Fi. JBH is the ticker code. I'll get Dean to weigh in after, but Andrew, you could probably talk about JB Hi-Fi in the context of what we've been discussing today, right?
Yeah, absolutely. I mean, it's actually a really great example, because here's a business that actually does, again, have a very high degree of stability. So it is one that I feel pretty confident in valuing. JB Hi-Fi's grown at sales at about 9.5% per annum, with 93% stability for the last decade. So that's a big tick for the stability of the model. Earnings have grown at 15% with over 80% stability. So again, big tick for the model. It's got high return on equity and return on capital, achieved with very low debt, even including the way lease standards treat debt now under the new accounting standards. And as a result, I've got a pretty good confidence that this is a business you can value using any approach you want, multiples or DCF. So if you look at it from a multiples perspective, let's start there. It's trading on a PE of about 18 times, which is at the bottom end of the long-term market average, but not cheap. It's sort of right in the middle. So from that point of view, if you wanted to do a multiples analysis, you could take a look at JB Hi-Fi, compare it to the market, compare it to other retailers. Retailers in general tend to trade at a bit of a discount to the market. And you probably come up with a view that says something on the lines of, this is a very good business, but it's probably fairly-ish priced. I'll wait for the price to be better. On the other hand, you could run a DCF on this and you can make some assumptions around the growth rate. But if you just take the average of the last sort of 10 years and run that forward using a discount rate of 10%, then JB Hi-Fi does look pretty attractive. You're getting a valuation 30% above the current market price. So the question you'd have to make at home, Gene, is are you prepared to jump into the business now when it looks somewhere between sort of fairly valued and maybe a little cheap? Or would you prefer to wait for Mr. Market to give you a bigger bargain? Now, I'm in the camp, as you know, that likes big bargains. So I would be putting a hold on it if we're going to use our call methodology. I think JB Hi-Fi is a wonderful business. I think it is easy to value, and I think it's got a very good value. I just think it's $78.60. I'll wait.
Okay, Dean, how do you value good old JB Hi-Fi?
Yeah, it's an interesting one. I mean, JB has just been such a blockbuster of a business. It is a pure category killer in Australia. If you're thinking about buying a TV or a computer or a mobile phone or any electronic gear or white goods, you kind of think about JB Hi-Fi or the good guys first up. That's why it's doing what it does in sales. That's why its margins are pretty good, and that's why it trades on I think for a discretionary retailer, a pretty rich multiple at kind of 18 times. At the moment, we're in an economy where there are a lot of headwinds. Obviously, the fuel price is one, rising interest rates, consumer sentiment's low. All those things should impact JB Hi-Fi's sales, and that's why I'd be cautious. But I feel like I've also had those concerns a number of times over the past decade, and JB Hi-Fi just tends to sail through them and punch out good numbers. The moment from a charting perspective, it looks like it's falling away and falling out of favour a little bit, and there are certainly a lot more cheaper, smaller discretionary retailers out there. So I'd probably just be waiting as well. I think you'll probably get this cheaper rather than more expensive, but it's never a business to write up because it's just, it's so iconic, and it's sort of what every Australian consumer thinks of if they want to buy a good split-based stock.
Yep, and we've got a whole AI revolution happening, so likely we'll have to retool in some way, shape, or form. Hey, listen, Dean Fergie, Cyan Investment Management, thank you so much for joining the program. Really appreciate your time today. And Andrew, thank you, as always. I mean, very different investors. You both are interested in a different type of company, but I think it really makes the conversation a lot richer. So from Teaminvest, thanks again. Thank you for your questions. Don't forget you can ask one at wealthy@ausbiz.com.au. Thanks for watching this week. We'll see you next week.
We hope you found today's discussion insightful and inspiring. If you know anyone else who could benefit from hearing this episode, please hit the share button and pass it on. If you'd like to learn more about Teaminvest or our unique investment approach, visit us at teaminvest.com.au. And please don't forget to subscribe to the podcast for more episodes. Until next time, stay informed, stay invested, and keep building wealth.